Imagine waking up tomorrow morning and seeing every news channel screaming the same headline. The stock market just crashed 35%. Wall Street is in chaos. Your retirement account is bleeding. Your coworkers are talking about selling everything. Financial YouTubers suddenly become prophets. And somewhere, sitting comfortably with a giant pile of cash, someone smiles. This is it. This is the moment I've been waiting for. For years, they've ignored the market. Skipped investing. Watched everyone else buy stocks at record highs. Because they believed one simple rule. Why buy today when I can buy after the crash? It sounds logical. Actually, it sounds smarter than investing every month. After all, everyone says the secret to investing is simple. Buy low. Sell high. So why would anyone keep buying while prices are climbing? Wouldn't the smartest investor simply wait for disasters? Wait for recessions. Wait for crashes. Then buy everything at a huge discount. It feels like common sense. But what if that strategy quietly destroys your wealth instead of building it? Even stranger. What if someone who completely ignores the news, never predicts crashes, never studies charts, never times the market, actually ends up much richer? Today, we're putting that idea to the test using decades of real market history, academic research, and one of the most surprising investing experiments ever conducted. Because the results completely changed how many professionals think about investing. And by the end of this video, you'll probably never look at cash sitting on the sidelines the same way again. Meet Della. She's 27 years old. She just landed a solid job, finally has a little extra money every month, and wants to build wealth the right way. She isn't trying to become the next Warren Buffett. She isn't glued to CNBC every morning. She simply wants financial freedom before retirement. But almost immediately, she runs into a problem. One financial expert tells her, start investing immediately. Another says, the market is way too expensive right now.
Can't be real. My retirement account.
Someone on social media warns that a historic crash is just around the corner.
Wall Street in absolute
Her
chaos.
uncle insists, cash is king. Just wait. You'll buy everything cheap later. Another YouTube thumbnail screams, biggest crash in history incoming. Another says, this bull market is just getting started. Within a week, Della isn't learning about investing anymore. She's trying to predict the future. And that's where millions of investors accidentally make their first expensive mistake. Not because they're careless. Because they're trying to be smart. Here's something interesting. Most people think investing is mainly about choosing the right stocks. It isn't. Before that, almost everyone faces a much bigger question. When should I start? Should you invest today? Next month? After the election? After interest rates fall? After inflation cools down? After the next recession? Or after the market crashes? That last option feels incredibly attractive. Because nobody likes paying full price. If your favorite TV suddenly goes on sale for 40% off, you celebrate. If airline tickets drop in half, you book immediately. If your dream house suddenly becomes cheaper, you feel lucky. So naturally, people assume stocks work exactly the same way. Why buy today, when a better sale might be coming? It sounds perfectly rational. There's only one problem. The stock market doesn't behave like a shopping mall. Think about climbing a mountain. You don't wait at the bottom hoping the mountain magically gets shorter. You simply start climbing. Some sections are steep. Some are flat. Sometimes you even slip backward for a while. But over time, you're still moving higher. The stock market has behaved surprisingly similar throughout history. Yes, there are frightening falls. Sometimes brutal ones. But zoom out over decades. And the overall direction has been remarkably consistent. Upward. That's because behind every stock price is something real. Companies invent products. Businesses expand. Technology improves. Workers become more productive. Entire industries evolve. The economy keeps creating value. And over long periods, stock prices have reflected that growth. That's why simply waiting can become much more expensive than most people realize. Let's imagine two different futures for Della. In one version, she starts investing today. Nothing fancy. No stock picking. No prediction. No guessing. She simply invests the same amount every month into a broad market index fund. Whether markets go up, down, or sideways, she keeps going. In another version, Della decides she's going to be smarter. She opens a savings account instead. Every paycheck, she adds money. But she refuses to invest until the next major crash finally arrives. She feels patient, disciplined, responsible. Every new market high actually makes her happier. Because in her mind, the bigger the climb, the bigger the eventual discount. At first, this strategy feels amazing. She's never worried about temporary losses. She's never stressed during market volatility. She sleeps great knowing her cash is safe. Meanwhile, her friends keep investing into what looks like an increasingly expensive market. She quietly thinks, they're making a mistake. Months pass. Then a year. Still no crash. The market climbs another 12%. Della feels a little uncomfortable. But she sticks to the plan. It's gone too high now. It has to fall eventually. Another year passes. The market keeps climbing. Every month she delays. She becomes even more convinced waiting is the right decision. Because now buying feels even harder. I've already waited this long. I'll just wait a little longer. Without realizing it, waiting slowly transforms into a habit. And habits are surprisingly difficult to break. This is one of the biggest psychological traps in investing. The longer you wait, the harder it becomes to start. Behavioral economists call this commitment bias. Once our brains commit to a decision, we naturally begin searching for evidence that proves we were right. Every scary headline becomes confirmation. Every economist predicting recession suddenly sounds convincing. Every market dip feels like validation. See? I knew it. Meanwhile, positive news barely registers. Your brain isn't looking for balance anymore. It's looking for agreement. That's how intelligent people stay stuck on the sidelines for years. Not because they lack information, because they're emotionally invested in being correct. Now here's where things become really interesting. Most people picture the stock market as a roller coaster. Huge drops. Huge rebounds. Constant chaos. Reality looks very different. Imagine an escalator inside a busy airport. It keeps moving upward almost all the time. Sometimes it stops briefly. Occasionally someone trips. Very rarely. The escalator temporarily shuts down. But eventually, it starts moving again. That's a much better picture of how markets have behaved over long periods. They're surprisingly boring. Until they suddenly aren't. Which creates an uncomfortable question. If the escalator spends most of its life moving upward, how long are you willing to stand beside it? Waiting for it to stop? Because history gives us an answer that almost nobody expects. And once you see the actual numbers, the entire idea of waiting for the perfect crash starts falling apart. Here's the first surprising statistic. Most people think stock markets spend most of their time crashing. Or recovering from crashes. They don't. In reality, markets spend the overwhelming majority of their lives doing something much less exciting. They climb. Not in a perfectly straight line. Not without setbacks. But over long stretches of time, they steadily push higher because businesses continue creating value. That creates an uncomfortable problem for anyone waiting for the perfect entry. Every month you're waiting, the market has another chance to leave you behind. Think of it like trying to catch a train. If trains only arrived once every few years, waiting for the perfect one might make sense. But imagine a train leaving the station every single day. Some are faster. Some are slower. Some get delayed. But every single one moves you closer to your destination. Now imagine standing on the platform saying, I'll wait for the absolute best train. Days become weeks. Weeks become months. Months become years. At some point, you're no longer optimizing. You're simply not traveling. That's exactly what happens to many investors. They confuse waiting with wisdom. Della doesn't realize she's fallen into that trap. Every payday, she transfers money into her savings account. Her balance keeps growing. And honestly, that feels satisfying. Watching cash pile up gives her a sense of control. Unlike stocks, cash doesn't swing wildly every day. It doesn't flash red numbers. It doesn't trigger panic. It just sits there. Calm. Predictable. Safe. Or at least, it appears safe. Because while Della watches her cash balance grow, something invisible is happening in the background. The market keeps compounding. Companies keep earning profits. Those profits create more profits. Investors reinvest dividends. Businesses expand into new markets. Technology becomes more efficient. The economic engine keeps running. Whether Della participates or not, That's the hidden cost most people never calculate. They focus on avoiding losses, while ignoring the gains they're missing. Here's a simple example. Imagine two neighbors each receive a $500 bonus every month. One immediately plants it into a fruit orchard. The other stores the money in a locked drawer while waiting for the perfect season. The orchard doesn't explode overnight. At first, nothing looks different, but each new tree begins producing fruit. Those profits buy more trees. Those trees produce even more fruit. Years later, one neighbor owns an entire orchard. The other owns a drawer full of cash. The second neighbor didn't lose money, but they lost something much more valuable: time. And in investing, time is usually more powerful than timing. This is where history starts telling an incredible story. Let's go back to one of the longest bull markets in modern history. After the financial crisis, many investors became convinced another crash had to be right around the corner. Every new record high looked dangerous. Every rally seemed unsustainable. Every correction was supposed to become another disaster. But year after year, the market kept climbing. Imagine sitting in cash while businesses doubled, then tripled, then quadrupled in value. You weren't making bad investments. You weren't making risky bets. You were simply waiting. And ironically, the higher prices climbed, the harder it became to finally invest. Because nobody enjoys buying something that's already become more expensive. This creates what's known as the price anchor effect. Your brain secretly remembers the old price. If you first noticed an index fund trading at $300, seeing it at $420 feels expensive, even if the companies inside that index have become significantly more valuable. Your brain isn't comparing value. It's comparing memory. That's why investors constantly say things like, "I wish I had bought back then." What they really mean is, "I wish today's prices looked like yesterday's." Unfortunately, markets don't care about our memories. Now let's introduce another investor. His name is Ryan. Unlike Della, Ryan never misses an opportunity to explain his strategy. Whenever friends talk about investing, he smiles confidently. "I'm waiting for the crash." He says it every year. Markets go higher. "I'm waiting." Markets pull back 5%. Not enough. Markets recover. "I'm still waiting." Another all-time high. "I'm definitely waiting now." Over time, Ryan becomes known as the cautious investor, the disciplined one, the patient one. People even admire him, because patience sounds responsible. But here's the question nobody asks Ryan. Waiting for what exactly? A 10% correction? A 20% bear market? A recession? A financial crisis? How deep does the drop need to be before he finally feels comfortable investing? Ironically, the larger the crash becomes, the harder buying actually gets. Picture yourself during one of history's biggest market crashes. News anchors aren't calmly discussing discounts. They're talking about bankruptcies, layoffs, banks failing, companies collapsing, experts debating whether the economy can recover. Every headline screams uncertainty. Would you confidently invest your life savings in that moment? Or would you wonder if prices could fall another 20%? Most people assume they'll become fearless buyers during crashes. History suggests something very different. Fear doesn't disappear during market declines. It multiplies. That's why major crashes always feel obvious. Only after they've already ended. Researchers have spent decades studying investor behavior. And one conclusion appears again and again. People aren't terrible because they lack intelligence. They're terrible because emotions quietly replace logic. When prices rise, greed whispers, "Don't miss out." When prices collapse, fear whispers, "What if this time is different?" Those emotional voices are incredibly persuasive, which explains why so many investors accidentally buy after prices have already surged, and sell after they've already crashed. Exactly backward. This is why automation is such a powerful investing tool. Della doesn't have to wake up every morning wondering what the market will do. She doesn't have to interpret economic reports. She doesn't have to predict interest rates. She simply removes herself from the decision. Every month, money goes into the market automatically. Some months she buys expensive shares. Other months she buys discounted shares. She doesn't know which months will matter most. And that's perfectly okay. Because she isn't trying to predict the future. She's participating in it. Now let's put this idea through a much tougher test. Imagine someone with an impossible superpower. Not someone who's good at reading charts. Not someone who's lucky. Someone who knows exactly where every market bottom will occur. Before anyone else on Earth. Could that person finally prove that waiting for crashes is the smartest investing strategy? You'd probably expect the answer to be yes. After all, perfect timing should beat ordinary investing every single time. Right? Surprisingly, real-world research found something that shocked even many financial professionals. And the results completely changed the way we think about buying the dip. We'll put that impossible investor to the test next. So, can anyone actually beat simple monthly investing? Let's make the challenge almost unfair. Forget experienced investors. Forget Wall Street professionals. Forget hedge funds with billion-dollar research teams. Imagine someone with a superpower. Someone who already knows the future. Not roughly. Exactly. They know the precise day every major market decline reaches its absolute bottom. Every crash. Every recession. Every panic. Every bear market. They never guess wrong. If anyone should dominate the market, it's this person. Surely they would crush someone like Della, who simply invests every month without paying attention. It seems obvious. But reality has a way of embarrassing what feels obvious. Financial researchers have modeled versions of this exact idea. The question was simple. What happens if someone saves cash and only invests at the perfect bottom of every major market decline? Then they compared that strategy with a completely ordinary investor who contributes the same amount every month into a diversified index fund. No predictions. No market forecasts. No waiting. Just consistency. The expectation? Perfect timing should win by a landslide. Instead, the advantage was surprisingly small. And across many long investment periods, the ordinary investor often finished with more wealth. How is that even possible? Because the game isn't won by buying cheaper. It's won by owning productive assets for longer. That's a completely different competition. Think of investing like owning a small apple tree. You have two choices. The first person plants the tree today. The second person waits years, hoping to buy the exact same tree during the biggest gardening sale ever. Eventually, that sale arrives. They buy the tree for much less. Congratulations. They got a bargain. But while they were waiting, the first tree had already spent years growing. It produced apples. Those apples produced seeds. Those seeds became more trees. By the time the second person finally entered the game, the first orchard had become an entire farm. The discount never caught up to the years of missed growth. That's the invisible force working against market timers. Every day you're invested, your money has another chance to compound. Every day you're waiting, nothing compounds except opportunity cost. Now here's something even more fascinating. Researchers discovered that being almost perfect isn't good enough. Imagine our all-knowing investor makes just one tiny mistake. Not a huge mistake. They simply invest a month or two after the exact bottom instead of on the perfect day. That sounds insignificant. After all, what's a few weeks over a 40-year investing journey? Turns out, it changes everything. Because the strongest recoveries often begin when fear is still everywhere. Markets don't wait for good news. They move before headlines become optimistic. They recover while television is still predicting disaster. They climb while investors are still convinced another leg down is coming. By the time the average person finally feels confident, much of the rebound has already happened. That's why trying to identify the bottom is so incredibly difficult. You only know where the bottom was after it's already behind you. Now let's go back to Ryan. Remember him? The investor who's always waiting for the next crash. Eventually, his moment finally arrives. The market falls. 10%. Then 20. Then 30. News headlines become terrifying. Friends start panicking. Social media fills with predictions of another Great Depression. Ryan opens his brokerage account. This should be the happiest day of his investing life. Instead, he freezes. Because everything feels different than he imagined. When markets are booming, buying during a crash sounds easy. When markets are actually crashing, buying feels reckless. Every instinct tells you to wait just a little longer. What if tomorrow is even worse? What if this company fails? What if the market falls another 20%? Fear always invents another reason to delay. Then, something unexpected happens. The market quietly begins recovering. Ryan notices. But now another emotion appears. Regret. I already missed the bottom. I'll wait for another pullback. Prices continue climbing. Weeks pass. Months pass. Eventually, he's right back where he started. Waiting. The crash he spent years preparing for came and went, without him ever truly participating. This is one of investing's greatest ironies. The strategy sounds logical because we imagine ourselves behaving logically. History says otherwise. Study after study shows ordinary investors consistently underperform the very funds they own. Not because the investments are bad. Because emotions constantly interrupt the process. People become excited after huge rallies. They invest. Markets fall. They panic. They sell. Prices recover. They wait for another correction. The cycle repeats. It's not a knowledge problem. It's a behavior problem. That's why the most successful long-term investors often look incredibly boring. They automate. They ignore noise. They stay invested. And they refuse to let emotions vote on financial decisions. Now, let's be fair. Does this mean buying during market crashes is a bad idea? Absolutely not. In fact, historic market declines have often created extraordinary opportunities. Buying during deep recessions has rewarded patient investors many times throughout history. The problem isn't buying the dip. The problem is refusing to invest until a dip finally arrives. Those are two completely different strategies. Imagine you're driving across the country, keeping extra fuel in your trunk for emergencies? Smart. Refusing to start the trip until gas prices become perfect? That's a completely different decision. One improves your journey. The other prevents it from ever beginning. The smartest investors understand this distinction. They don't sit on mountains of cash hoping for disaster. They stay invested. Then, if an exceptional buying opportunity appears, they may choose to invest additional money. The market crash becomes a bonus, not the foundation of the entire plan. So what should Della actually do? The answer is refreshingly simple. Invest consistently. Keep costs low. Own diversified investments. Increase contributions as income grows. Ignore daily market predictions. Treat market crashes as temporary discounts instead of permanent disasters. Most importantly, give compounding enough time to perform its quiet magic. Because compounding doesn't impress you in a month. It barely impresses you in a year. But after decades, it feels almost unbelievable. Tiny monthly investments become 6 figures. 6 figures become 7. Not because someone predicted the next recession, but because someone stayed invested while everyone else searched for shortcuts. At the beginning of this video, waiting for the next crash probably sounded like the smarter strategy. And honestly, that's what makes it so dangerous. It appeals to our instincts. Our desire to avoid mistakes. Our belief that patience automatically equals wisdom. But investing has a funny way of rewarding actions that feel uncomfortable. Buying when headlines celebrate record highs feels expensive. Continuing to invest during frightening corrections feels risky. Ignoring dramatic predictions feels almost irresponsible. Yet history repeatedly points in the same direction. The biggest advantage doesn't belong to the investor who makes the smartest prediction. It belongs to the investor who spends the most time participating in the growth of great businesses. That's a competition almost anyone can win. Not with genius. Not with perfect timing. But with consistency. So the next time someone proudly says, "I'm just waiting for the market to crash before I invest," don't ask them how much they expect stocks to fall. Ask them something much more important. How many years of compounding are you willing to give up while you wait? Because the market may eventually give you a cheaper price. But it can never give you back the time you spent sitting on the sidelines. And in investing, time has always been the rarest asset of all. If you enjoyed this breakdown and want more evidence-based investing videos that cut through the myths with real research and simple explanations, make sure to subscribe. And if there's another investing strategy you've always wondered about, let me know in the comments. There's a good chance the data tells a very different story than most people expect.